Okay, ladies and gentlemen, dear former students, dear current students, welcome to the third Hot Topics lecture organized and provided by the School of Economics and Finance at Queen Mary University of London. Today, we're going to have two esteemed speakers speaking on recent advances in real estate. The purpose of this event is to bring together the CEF alumni with recent developments on timely topics of importance to the industry and to academia. In the past, we had run events on topics such as ESG and financial technology. So today we believe we address another timely topic. So without further delay, let me pass the floor to Professor Jason Sturges, the head of the School of Economics and Finance. Jason, the floor is yours.
Thank you, George. Thank you for that very, very warm welcome. So, as George mentioned, I'm Professor Jason Sturges. I'm the head of the School of Economics and Finance these days. And it's an absolute pleasure to welcome you warmly back to school, albeit virtually. I know there's some of you are current students, some of you are recent former students, some of you are students perhaps on a sort of slightly farther back. So I'm going to sort of spend some of today explaining what the school looks like today. But also I think that's instructive for anyone studying even now, because it gives an idea of sort of how we want to shape the identity of the school, which includes our staff, our academics, our current students, and in addition our alumni. So I think the Hot Topics lectures are, to kick off, an incredibly important part of how we can actually sort of connect with our alumni network. Economics and finance are fascinating topics. That's why we study them. That's why we work in these markets. But they're also very fast moving. While on the one hand, we sort of learn, if you want, sort of the foundations, or if you want the toolkits, and these stay with us. The topics and how we apply these change because markets change so quickly. So the Hot Topics lectures are a way that we can give back to our alumni and ensure that actually they are, if you want, sort of upskilled on current topics. Real estate and real estate finance is one such topic. I personally find this fascinating. I have a little bit of research in this area myself, focusing on how, if you want, sort of the ability to trace finance against real estate varies across institutions of law. So clearly I'm interested in it. But furthermore, I think it's a fascinating topic because for many, many years, I don't think it was seen as that exciting. Okay, to be honest, I think there were financial markets existed in this area. But actually, as financial markets become more sophisticated, then a lot of financial market innovation occurred in this area. I think for a lot of people, they weren't fully aware of this until the 2008 financial crisis, when suddenly everyone was very aware of the financial innovation in this market. A lot of that innovation was good. Unfortunately, not all of it, I think, was sort of contracted or developed in a way that perhaps we hoped as financiers. Nonetheless, I think since then, there's been a lot of emphasis on real estate and finance, which is why it's become so important. I think it's so important as us as financiers to understand this. But furthermore, I think that it's not just important for financiers. I mean, real estate as an asset class is an asset class which affects all of us. So we can think about it from an asset pricing perspective. We can think about it from a corporate finance perspective. We can think about it from a household finance perspective. But furthermore, we can think about it as a macro finance perspective and really understand sort of how real estate markets influence the economic growth of economies and societies, and in particular how the types of contracts one provides in these markets really matters. And I think we've seen that more recently, whereby the explosion, if you want, of sort of the transfer of real estate from the public to the private market in China and the global financing of those markets has actually sort of led to, again, an instance whereby a local real estate market has had global financial market implications. And I think that's something which is still unraveling today. And that just emphasizes how important it is when we think about this market. So I'm very excited about the lectures coming up, and I think you should too. And again, this is something which I think for some of you, when you were at the school, we didn't have a real estate finance module. These days we do, because it's so important. But it's sort of, if you want, it's an up-to-date modernization of the programs. So the school itself, some of you may be more familiar with this, some of you may not, but the school, I think, sort of has a sort of deep-rooted, if you want, vision, and this is to deliver teaching and produce research across economics and finance that provides the foundations for our community, which again includes students, alumni, faculty, to engage with the real world on the most pressing challenges facing societies and economies today and tomorrow. And that's why I think topics such as this are so important. And I think this identity is reflected in, if you want, the shape and scope of the school today. We produce world-class research. I think we produce world-class research both on, if you want, sort of theoretical, more applied topics, economics and finance. This has been reflected in the most recent UK research evaluation framework in 2021, whereby the school was evaluated as being number 4 in the UK based on economics research. We are currently ranked number 84 in the global QS rankings in economics, which puts us among the best economics institutions globally. We're also top 100 of the Shanghai Global Rankings for economics in China. But furthermore, we don't just stop at research to really have an impact, both for our students, our alumni, and sort of beyond. We make sure we take that research to the classroom. So ultimately, our ambition is to have research-led excellence in teaching. And this has been reflected not just in terms of our evaluations in teaching, but also in terms of the recent partnerships we've developed. So this has been recognised by the UK government, investment banks such as Goldman Sachs and Deutsche Bank, who have partnered with us to develop new programs whereby we help upskill their own staff, especially staff who perhaps don't come from the most privileged backgrounds. So basically, we're using these types of programs to open the doors to careers in economics and finance. And while not everyone sits on these programs, it does mean that all students with us have a similar experience of this type of teaching, which ultimately I hope or I believe gives them the opportunity to have impact beyond studying with us through their careers. Furthermore, where I think about school is going, ultimately we want to build on this success in research, this success in teaching. And I think a lot of that is going to be thinking forward about our alumni. And that's why I think these types of events are so important. So for me, when I think about the school, ultimately it's all about reputation. I think about any sort of, if you want, institution which such as a university, where we're thinking about human capital, it's ultimately about reputation. And a lot of our reputation sits with our alumni. So when I think about the students we've got today, what we're ultimately doing is we're developing and building and in the future supporting our alumni to go on and be the best they can and help us build not just their reputation, but the reputation of the school. And that just really leads me to sort of encourage you to be engaged in being alumni of the School of Economics and Finance. Reach out to us, keep in touch, and work with us to further improve the alumni relations. I'm very much looking forward to the lecture today, and I'll hand back over to George so we can move on. It's good to see you all.
Thank you very much, Jason. So we can move on now with the two our esteemed speakers. Let me briefly navigate you through the layout for today's event. So each speaker is going to have 30 minutes to deliver his presentation. And at the end of the two presentations, we're going to have about 15 minutes for Q&A with the audience. So feel free to drop your questions in the chat box, or if you wish, you can pose them orally at the end of the two presentations. So let me start with the first speaker, who is Dr. Roman Šustek. Roman is a reader that is an associate professor with the School of Economics and Finance, And his expertise lies in housing markets, mortgage markets, monetary policy, and macroeconomics. Roman holds a PhD from Carnegie Mellon, and he has held positions in various institutions and universities, including the Bank of England, the Fed of St. Louis, Southampton, and Iowa, among others. Roman is also serving as associate editor of the European Economic Review. And today, we believe that Roman is a fine example of what Jason stated previously, to showcase the expertise of the School of Economics and Finance in such a hot topic like real estate. So Roman, the next 30 minutes are yours.
Okay, well, thank you, George, for the nice introduction. So let me, I guess it's probably best if I start sharing the screen. Okay. Okay, I hope, George, can you just confirm that you can see the slides?
Yes, I can, Roman. Thank you.
Okay, well, thank you for giving me this opportunity to speak to our alumni. And what I'm going to do in this talk, it's just going to give you a bird's view of the long run developments in housing markets, in particular in house prices. So this is not going to be much about a lot of details. This is just going to give you some long-term overview what house price developments have looked like around the world. Okay, so the main takeaways from this talk are going to be that house prices started to grow only after the 1950s, and that the growth rate is due to the growth rate of the price of land, not to the growth rate of the construction costs. Since 1950, house prices have significantly and persistently deviated from their trends. But on trend, they grow at about 2% per year. So if you want to take away some ballpark numbers, then on average, across many countries, in the long run, since 1950, house prices grew on trend by about 2% per year. But they have significantly departed from those trends. Now, this is approximately equal to the growth rate of income per capita plus population growth minus the growth rate of the housing stock. That's how you get roughly those 2%. Now, what can explain those deviations from trend? Well, to a large extent, they could be explained by fluctuations in the expected growth rate of a long-term GDP or long-term income. In terms of course, when you think about housing as an investment, the growth rate of house prices is not the only way how you can make a return. The other part is rental yield. Now, the interesting fact is that when you look at across countries, the total return on housing, which is the rental yield plus house price appreciation, on average in the long run is about 7%, regardless which developed economy you look at. And interestingly, when you look at the stock market, that's also 7%. Now, this 7% can be roughly broken down to a 5% rental yield and 2% house price growth. And when you look at across markets within a given country, then what you see is that the 7%, this breakdown, it kind of varies across locations. Some locations give you more in the rental yield, other locations give you more in the house price growth, and you can really think about the locations in the same way you could think about value stocks versus growth stocks. So a lot of the lessons that we know about stock market apply also to the housing market. Okay, so I'm going to go through this in a little bit more detail. This is going to be mainly about the data. And then at the end, I'm going to just touch a little bit on very, very simple theory that could make sense of the data. So hopefully, what you'll take away from this talk are some interesting facts that perhaps some of them you didn't know about. Okay. So, but first, what is the current state? So let's look at house prices between 2015 and 2023, which have been attracting a lot of attention. So I'm just going to give you, as a starting point, just to start off, where are we at the moment? So first, let's look at some Anglo-Saxon countries. So these are all average real house prices within a given country. Real house prices, it means it's the nominal house prices adjusted for the inflation of the general price level, such as CPI. Okay, so everything I'm going to say in this talk is going to be about real house prices adjusted for general inflation period. And now we can see some reversal. Now, if you look at the German-speaking countries that are often mentioned as a counterexample to the Anglo-Saxon countries, because German-speaking countries have on average much lower home ownership rates. For instance, Switzerland has only something about 46% of a home ownership rate, and it used to be even lower, something like 30% maybe 20 years ago. But again, even in these countries that have a very different structure of housing markets, we can see that now we are entering some kind of a downturn after a fast growth since 2015. The same holds for Benelux and France. And Nordic countries. Sweden, if you've been following the media, has been attracting a lot of attention, but kind of picture that we see in Sweden is kind of universal across Nordic countries. And the same goes for Central Europe. Again, we see beginning of a downturn after periods of a fast growth. A little bit mixed picture in East Asia, but again, we just don't see, any sort of a boom apparently continuing at the moment. Okay, so this is just, taking the current stock of where we are now. So what, however, 100 years or more of data tell us about house prices. Okay, so how can we put all of this into some kind of historical context? Well, there is a very nice paper by these authors published in American Economic Review in 2017 that collected data for real house prices for a number of countries going back to the late 19th century. And what comes out of all this data is that house price growth, that's fairly recent phenomenon. Recent meaning that it really started only after the end of Second World War. So here is an example of Australia. You can see there was hardly any growth in house prices in Australia for about 70 years. And then we see this fast pickup from 1950. Something similar you find in other countries like Denmark. Almost no growth in house prices until the end of the Second World War, and then a fast pickup. Here is France, the same picture. Japan, we're going to come back to Japan. Again, just the main point here, no growth in house prices until 1950, then again, fast boom, and then the well-known bust. This is the United Kingdom, the same picture. Almost no growth in house prices until 1950. This is just the collection of countries that these authors have looked at. This is 14 countries. The starting data point differs across these countries, but for most of them, it goes back to 1870. And you can just see, no growth in house prices up until 1950. And then, growth starts. All of this gets a little bit scaled down because of the dominance of Japan. This, phenomenal house price boom and bust. But like we saw in the previous pictures, growth started in most countries only until 1950, or only after 1950. So that's it's house price growth that we tend to think, often media would try to convince us house prices can only go up, while we see that they not only sometimes go down, but also for a lot of our history, they have hardly changed. Now, what could account for this, pattern in house prices over 100+ years? So this chart, taken again from the paper of those authors, we plot an average house price index for all the countries that we have seen in the previous slides against the real cost of construction. So the cost of construction adjusted for general inflation. Now the green line, the green dots, that's construction costs in this average construction cost in this sample of countries. The red line is house prices, the average house prices in these countries. And we can see that just construction costs have no chance accounting for these developments. Construction costs, the trend is just way too smooth to account for the fast pickup in house prices after the 1950s. Well, then what else could it be? Well, if you think about what's a house, I mean, house is a combination of a structure that needs to be built, and that's reflected in this construction cost, and the land. So if it's not the construction cost, it better be the land that accounts for this trend in house prices. And indeed, that is the case. We see here, the red line again is a house price index, and the green line, that's the value of land. So this picture shows that this this general growth in house prices after 1950, is predominantly driven by an increase in the price of land, not the price of structures, not the cost of construction. The same picture comes out in a little bit more, kind of more detailed data work for a shorter period of time by these authors, Davis and Heathcote, published in Journal of Monetary Economics 2007. This was actually the first paper that has done this decomposition of house prices into the price of structures, so construction costs, and the value of land. They've done it for the United States from 1975 to 2007. And what we can see here, the red line is the average price of home in the United States. The green line is the average real construction cost. And then the blue line is residential land, the value of residential land. So for instance, you can see that this big boom that started in 1995, it's almost exclusively driven by the price of land. I mean, the construction costs go up as well, but I mean, by no means as much as the price of land. Also, the price of land is way more volatile than the construction cost, and that's reflected then in the volatility of house prices. So we want to understand house prices, we really have to understand, the value of land. Now, what we looked at the prices, let's look at the quantities. So this is the chart shows the growth rates of the quantity of new residential land, quantity of structures, and quantity of homes. So as I said, if you put a land and structure together, that gives you a home. The blue line is the growth rate of the quantity of new residential land. So this is what the authorities, release and allow developers to build on. Then the green line, that's the growth rate of structures. So that's basically, you can think about it as construction activity. And the red line is the growth rate of newly constructed houses. And what you can see is just that the growth rate of land is fairly constant. It's almost like land was a fixed factor. Regardless of the economic conditions, it's almost the same amount of land that is released every period. Okay? It's very irresponsive to general economic conditions. So in periods where that we would require more land to be released, like boom periods, there's more demand for new housing construction. The amount of land that is released by authorities, even in a country that is as flexible as the United States, is fairly sticky, fairly irresponsive. So you can really think about houses, the house price is mainly driven as the prices of land, and land being kind of a fixed factor in production. Now, of course, this was the aggregate. The importance of the value of land really differs across locations. So this is various locations in the United States. And I have circled the location with the highest share of the value of land and the lowest. So in San Francisco, so this is the 1998, so this number would be now much bigger, but it's 80% of the value of that average house in San Francisco, 80% was the value of land. As opposed to St. Louis, where the value of land was only 11%. 89% was new construction. That is in a fixed supply, something that doesn't respond to economic conditions very much. And you can think about a home in St. Louis like a car. When you think about cars, it's a durable asset, just like a home. It gives us, some services over time. But we never think about booms and busts in the, price of cars. The price of cars is determined by the marginal cost, just like the price of a home in St. Louis is determined by the marginal cost of construction, as opposed to San Francisco, where it's just the value of that fixed factor value of land. Okay, so that was kind of a picture of 100 years plus, with some little bit more focus then on the value of land for a shorter period of time. Let's look at, in more detail on that period from 1950, which, as I mentioned, is the period when house prices started to grow. So I'm going to argue that based on the data that we have, we basically see three patterns, and I'm going to go through these patterns with you. So pattern number one from 1950 is Japan, which we already saw. It really stands out. So in this plot, I'm plotting the aggregate house prices, the average house prices in Japan, again in real terms, and just for comparison, I'm plotting those house prices against house prices in the United States. Now, I have circled here the boom-bust period in the United States that, a lot of economic research has focused on, and of course, a lot of kind of policy work has focused on. So during the boom-bust period in the United States in the 2000s, during the boom period, house prices grew about 5.4% per year in real terms, and during the bust, they declined by a little bit over 5% per year. Now, compare it to Japan. So in Japan, for almost 40 years, house prices grew at staggering 9.3% per year in real terms until 1990, after which they declined by 3.2% per year for another 20 years. No other country has experienced such a boom and bust cycle in house prices. At the opposite spectrum is Switzerland. So Switzerland, the real house prices in Switzerland, that's the dashed yellow line. There is almost hardly any trend in Switzerland. House prices, I told you in the opening slide that on average, house prices in most countries grow like 2% per year in the long run. In Switzerland, it's only half of that. However, Switzerland has these pronounced boom and busts that are at the magnitude comparable to the boom and bust in the United States in the 2000s. So sometime just today, I read an article in the papers arguing that governments should support rental markets, because if there are more people renting, that would somehow take away booms and busts in house prices. Well, we can see here in Switzerland, I mean, it's a country among the developed countries with the lowest home ownership rate, yet it experienced cycles of a magnitude comparable to the United States, the boom-bust period in the 2000s in the United States. Most countries, however, have this pattern. So this thick blue line, it's what we call a first principle component. It's a statistical kind of a technique to extract some commonality in house prices in different countries. It turns out that many countries, at least advanced economies, have a pattern that corresponds to this pattern. So this is based on Australia, Belgium, Canada, Denmark, Finland, France, the Netherlands, Sweden, and the United Kingdom. So 10 countries, which I call G10. So all of these countries have a pattern similar to this one. What's interesting about that pattern is that there was about 1.7% moderate growth up until mid-1990s, and then an increase, acceleration in the growth rate when house prices grew at almost 5% per year up until 2007. Okay. So this is kind of what I would call a hockey stick pattern that characterizes house prices in most countries. Okay, so now I'm going to talk about the deviations of these house prices from a trend. Now, I could talk in a lot of details about how the trend is estimated. It comes from a recent paper of mine with a colleague of mine from Queen Mary, Harun Mumtaz. And I'm going to show you, an estimate of a trend in house prices and then the deviations of house prices from the trend. So this is Japan. So our estimate of the trend for Japan is the green line. You can see, If house prices stayed on the trend, well, there would be, house prices would grow, but not as much during the boom period as in the data, and there would be no bust. House prices would just level off. I'm going to come back to, what the trend in general, is accounted for in a couple of slides. In Switzerland, again, we have, an estimate of a trend, and we see, big fluctuations in house prices along that trend. Now, and finally, we have these G10 countries. So against the average, the first principal component of house prices and the first principal component of the trend, which you can, for all practical purposes, think about it as an average. You see again, persistent deviations of house prices from that trend. Now, when you look at, on average, these deviations, they are like one standard deviation of those departures from trend amounts to about 20% departure of house prices from trend. So when you see house prices about 40% from where you would expect them to be relative to income, relative to GDP, relative to rents, that's not unusual. That's actually something that statistically we see in the data. And those departures can be very persistent. So half of the gap, according to our estimates, gets closed in about 8 years. So these are very significant and persistent departures. And the question is, what accounts for the trend and what accounts for those departures from trend? So again, things are a lot more complicated. Oops, that I didn't want to. Oops, sorry. I don't know whether that red line, how that came there. Things are, of course, a lot more complicated than I'm gonna make them sound, but just to give you some ballpark figures and some bird's view of the situation. Here, what I'm showing in this table is average house prices in these countries. So the black countries, the black numbers are from 1950. The brown numbers, I mean, we have data only from 1970. So those are from 1970. So I have the average growth rate in real house prices, the average growth rate of population, the average growth rate of GDP or income per capita. And then I'm going to sum them up. Okay. So you can see the average growth rate of house prices, as I said in the opening slide, across these countries, it's about 2.18%. Okay. So as I said, the ballpark figure, you can think about the average long-run growth rate of house prices after 1950 is 2%. Now, population growth is about 0.7. You do the sum, about 2.83%, that, based on these two figures, house prices should grow at. The discrepancy is easily that I'm making them sound, but as you want to come up with, leave with some rule of thumb, you can really think about house prices on a trend since 1950 as being given by the sum of the growth rate of population, the growth rate of income or GDP per capita, less the growth rate of the housing stock. So what explains the deviations from trend? Well, it turns out, again, things are way more complex than I'm making them sound, but again, if you just want to use some easy rule of thumb or some very general lesson, then a good chunk of those fluctuations away from the trend get accounted for by movements in the expected long-run growth rate of income per capita or GDP per capita. So this chart shows on the x-axis is the long-run estimate of the long-run growth rate of GDP in a given year and a given country, 1950, 2019, and the y-axis is the deviations of house prices from the trend in a given year and a given country. So for instance, a particular dot would be, let's say, Japan, a combination of the long-run growth rate in Japan and the deviation of house prices from trend in Japan in a particular year, and so on for the other points in the scatter plot. Now, how can we make sense of it all? Okay, so I've given you, a lot of data. I've given you, a lot of numbers and charts. How can we make sense of it all? Okay, well, we can rely on what we've learned in basic finance. The Gordon growth model that we normally use when we talk about stock prices, it also works for housing. Just a refresher, a price of an asset is equal to the expected price of an asset discounted next period and some cash flows, okay, some dividends in the case of stock. So in the case of housing, D could be market rents, but it could also be the implicit rents period that they live in the house. Now, if you can, iterate this equation forward, and what you get is that the price and the housing stock. Okay, so it doesn't really matter much of what you use as in the denominator. So this can call it as fundamentals. So the ratio of the house price to its current fundamentals is given by the inverse of the difference between the rate of return on housing and the growth rate of the value of housing services. So now if you think that the value of housing services is to a large extent, how much people are willing to pay, not for the house, but for the services each period, depends on their income, then if the expectations of this income growth increasing in the future to housing finance. The other variable is, of course, the rate of return, but I didn't talk about that. So finally, last two slides, what you can do also, you can flip that equation around and you can write the rate of return on housing as a sum of the inverse of the price to dividend or price to rent ratios, what people in housing finance call the rental yield, and the house price appreciation. Now, what's an amazing fact in the long run is that this rate of return on housing is about 7% per year. That holds over a period like the past 70 years in developed economies. Interestingly, it's the same rate of return as you would get on investing like in S&P 500. Now, when you do the split, again, on average, across countries over the past 70 years, that you get 5 percentage points of that 7% is accounted for by rental yield. 2 percentage points, as we have already seen, is by house price appreciation. This is the reference to the paper that documents that. However, within a country, within different markets in the country, there is a lot of variation in how this split, what that split is. And that's my final slide. So this shows a number of municipalities in the United States, Houston to San Francisco, and it plots the net yield, the rental yield, and the house price appreciation. So this is for a shorter period than the figures on the previous slide. This is 86, 2014. So when you add these numbers, they are higher than the 7% that I mentioned for the past 70 years. But what's interesting is that when you do these sums, you get like 9%, you get about 10% across the locations. Doesn't matter whether you're going to invest in San Francisco or Houston, fast growing city or kind of a not so fast growing, didn't want to say boring, but you get my point. You're going to get 10%. What's going to be different is where those 10% are going to come from. So in the case of San Francisco, your rental yield is going to be very low, but house price appreciation and expectation high. The opposite is going to be true for Houston, where most of that return is going to come from rental yield. Okay, that's all I had for this talk. Thank you for your attention, and hopefully, this has given you some overview of the long-run trends and some interesting facts that perhaps you didn't know about, and maybe a very, very simple way how you can think about those facts from a model that most of you, I guess, are familiar with.
Thank you very much, Roman. Thank you so much for your stimulating presentation. I'm sure we'll have plenty of questions to discuss at the end of the session. May I remind to the audience to drop any questions they may have for the speakers in the chat box. And now let's move to the second distinguished speaker, who is Mr. Panos Koliousis. Panos is director with CitiBank. He's an expert in originating, structuring, and executing transactions on commercial real estate. He has a wide experience serving in various institutions, including the National Bank of Greece and Deutsche Bank. And Panos also has impressive academic qualifications. He's holding a first degree from the University of Piraeus with valedictorian, an MSc in Economics and Finance from LSE, and an MBA from LBS. Panos, thank you very much for accepting the invitation. Actually, I should say that this Hot Topics lecture event combines expertise from academia and from distinguished professionals like Panos. So Panos, the next 30 minutes are yours. Thank you.
Thank you very much, Professor Skiadopoulos. I'm very delighted to be here with you today and actually discuss a topic which is very close to my heart as well, with a very distinguished audience like you. Again, a big thank you to Professor Skiadopoulos for giving me this opportunity to speak with you. A couple of disclaimers. The first one is that, just like you, I have also been one of Professor Skiadopoulos' students in the past. However, any mistakes that I make today are my mistakes, so I take responsibility for them. And a second disclaimer is that I express views for myself, not for my employer. So Roman gave an excellent talk on what is happening on the residential real estate market globally. Together with you, I would like to explore how the commercial real estate sector is faring, how it is doing. And actually, this is indeed a very interesting time to discuss. Also mentioned previously by Jason in the beginning of the talk. It's a very interesting time to discuss about that sector because there are both cyclical changes, but also structural shifts that the market faces. So I really hope that all of you will find this discussion interesting and hopefully thought-provoking. So let me try to share the presentation. Here we are. I hope that you can see that. So before actually we delve into the details, I just wanted to give you a very brief description of what commercial real estate is. So you can actually appreciate its role as part of...
Panos, sorry
Yes?
for interrupting. If you could please magnify in full screen your file. That would be
Yes, yes.
Thank you.
Is it like that? Does it work?
That's excellent. Yes, thank you.
Perfect, perfect. So a brief description of what commercial real estate is, so you can actually understand its position as part of an investment portfolio. So commercial real estate actually consists of buildings or land with the intended purpose to use it to generate profit, either in the form of capital gains or through rental income, or actually through both capital gains and rental income. And there are actually quite big variety of types of properties that fall within the commercial real estate definition. Over the next couple of slides, I can show you actually around 20 of them. The main categorizations, if I can say that, are between investment properties like offices, logistics, retail, versus operational properties like hotels, student accommodation, or build to rent. Or another categorization is between core real estate, which is again retail and offices, versus alternatives. So this can consist, for example, of data centers, healthcare properties, laboratories, roadside and automotive, so all the rest, practically speaking. To give you a brief idea of how significant as an asset class real estate is on a global scale, I need to mention or highlight that real estate is actually the third largest asset class after fixed income and after equities. Now, commercial real estate as a global market, or the biggest actually global market for real estate is, as you may expect, the US, approximately $48 trillion size, which is then followed by China. And if we think about how the UK market is faring, or how big is that, on a commercial real estate point of view, it's around £1 trillion, which is practically broken down equally between retail properties, office, and industrial properties. Compare this with residential properties, which is around 7 trillion. And if we consider other structures like land or everything else, the total size of the UK market is around 10 trillion GBP. So quite significant, quite large. So the UK market has a quite big, a significant role as part of the investment portfolios. The commercial real estate market in the UK, as you can see in this graph, it has actually more or less doubled since the early 2000s. And what is also interesting to see here is the fact that there is cyclicality in this sector. You will notice the value drop during the 2008-2009 period. That was the global financial crisis. And actually also over the last couple of years as well, with all the challenges that we're going through at the moment. Now, the UK CRE market is considered, first of all, institutionalized in the sense that the key players are big institutional investors like REITs. It is also globalized in the sense that around 1/3, around 30% of the properties are actually owned by foreign investors, be it individuals or be it institutional type of investors. It's also a very competitive market with very few dominant players. In this slide, you may recognize some of them like British Land, Segro, Land Securities, etc. And there are quite few dominant players of them. As a next question, I suppose that you may naturally ask, okay, how do we can actually get exposure to this market? How can we invest in this market? And the reality is that, as can be shown here, there are plenty of ways actually to invest in the commercial real estate market. It can take the space of direct acquisitions. So you can form, for example, JVs or clubs with other investors, or you can invest in this asset class indirectly. For example, by investing in listed securities like REITs or via funds. Jason at the beginning also mentioned that real estate is everywhere in our daily life. And indeed, possibly you may have already been personally invested in the UK real estate market through your pension fund, for example. So potentially your pension provider may have already invested part of your funds in real estate in the UK. But now, contrary to the, let's say, the more passive or the more straightforward investing in fixed income or equities, what are the special considerations actually that we need to think about when we invest in the real estate market, especially when you invest with direct acquisitions? The key element is the fact that properties need your attention in the form of active asset management. At some point in the asset's lifetime, you will need to refurbish the asset, you may need to reposition it, you may need to relet it. So effectively, this means that you need specific expertise and experience in the field to make sure that you can actually support such an investment. Also, you have heard throughout your courses that diversification is what everybody should look for. And investments in commercial real estate are usually lumpy in size. So it is generally more difficult to build a very well diversified portfolio. It's doable, but it's practically more difficult. Liquidity is also a key concern, especially when the market is falling, because typically you can actually sell a fixed income portfolio or an equity portfolio instantly, whereas it takes between 4 to 6 weeks between exchange of contracts and completion to sell a real estate asset. So it takes longer in that sense, which means more risks involved. Also, the trading costs are also significant. It's between 6 to 7% of the transaction value. And this is mainly related with taxes like stamp duty and advisory fees like lawyers, valuers, tax advisors, and everything. Now let's look at actually what is happening today in the market and actually which are the main forces that they really shape the market. I'm sure most of you have seen so many news, especially over the last couple of years, of what is happening in the market, talking about challenges, talking about specific difficulties across countries, I would say, and across geographies in general. I have put over here a couple of photos that can actually prod your interest in that. The reality is that, as we have already said at the beginning of our talk, the market really faces both cyclical challenges and structural shifts. And there are indeed a number of headwinds, if I can actually use this euphemism, which drive those structural shifts and changes. COVID, well, I expect that you would expect to hear this word in this kind of discussions. Interest rates, inflation, debt availability, geopolitical risks, and sustainability. So all of these factors and even more, actually, when are combined, they naturally put pressure on asset values. Let's try to have a look a little bit more detail of these factors and how do they really affect the real estate market. And actually, let's start with the rates, the interest rates. What I have put actually here is actually a graph of the Bank of England rate since the 2014 or so. You will notice in this graph that there have been, I think, 14 rate increases in the last couple of years. If you compare now this period with a flat sub 1% of rate over a prolonged time, you'll understand that there has been a key significant change. And by the way, this happens globally with other central banks as well. But what does it mean? I mean, how does the rate can affect the market? The reality is that the market had been adjusted to very low rates for a very long period of time. And so if the rate increases now, it will actually have two main impacts, I can say. The first one is on the value. The investors simply require higher yields nowadays, since they have alternative assets to invest. For example, they can invest in a government bond and get 5% or so. If you think about a very simplistic form of valuing a property, is as Roman mentioned before, is about discounting the cash flow of the property. So as the denominator increases because the rate increases, you expect the value to adjust downwards. So that's the one impact, one key impact. And the second, also very important impact of increased rates is a debt serviceability and debt availability. Rates up means interest costs are significantly higher today. And apparently the key question is whether the properties underlying cash flows, they can really support existing loans. More on that a little bit later when we discuss about debt later in our discussion. The next headwind is apparently inflation. Inflation is linked with interest rates. As central banks, they try to increase the rates to tame inflation. However, I think that what is equally important when there is such an inflation mark here is that inflation typically impacts economic conditions, especially when inflation turns to stagflation or worse. When you have this kind of economic conditions, this can really affect the occupational demand. So in other words, the level of rental income that you can make from your property, or even the level of the property vacancy, because tenants may go bust in that period and leave a property empty. Because as a general rule is that good economic conditions means higher demand from tenants for properties in general, be it offices or be it industrial space as well, for example. Perhaps a positive, if you can put this way, a positive impact when you have high inflation is the fact that the construction costs are typically higher, which means it typically leads to lower construction activity, so lower supply. So this can actually support the demand supply imbalance, so support the values of the properties. But that's a secondary consideration, I would say. Debt availability that we touched upon a little bit earlier. Everything in the financial markets, as you have learned in your courses, are interconnected. So practically those headwinds that we discussed, they really affect the availability of debt. You may have come across the phrase wall of debt. In the US alone, this year and next year, as you can see here in the graph, there is around $1.1 trillion of loans expiring. So in that case, the borrowers are expected to face a double hit in the form of refinancing at higher rates, which means higher costs, and probably lower loan amounts as well, which means practically that you need to be more creative in terms of equity structures and how much more equity needs to be put in the game. However, that's actually a concern. However, if you compare it, for example, with the global financial crisis period, I believe that the market is better prepared now, I would say for two main reasons. The first one is that the credit quality seems stronger nowadays, as the typical loan to values have been in the 50 to 60% roughly levels. So practically there is significant equity cushion. And secondly, there's a more diverse lender population nowadays compared to last years or last crisis, as both banks and non-bank lenders, like debt funds, are active in the market, so they can really provide liquidity in the system. Now, let's turn to COVID. Perhaps COVID is the second most common word used nowadays after artificial intelligence, I suppose. It used to be number one a couple of years before. Without a doubt, COVID has been a force that has caused a structural shift in the market, undoubtedly. It has acted like a catalyst for change in the way that we work, we shop, and we live in general, I believe. However, it has really impacted different asset classes in a different way. And there have been also differences across geographies as well. So if we look this graph here, and if we actually first turn our attention to offices, because this asset class seems to have been affected the most from COVID so far, there have been actually two key changes in the office sector from COVID. One is called hybrid working, and the second is flight to quality. Keep those phrases because they're quite significant. Hybrid working, what does it mean? That some percentage of your workforce doesn't come to your office to work. So this has actually led companies to reassess their occupational needs, meaning how much space do you really need, you as a company, to occupy. And this has practically disrupted the demand for office space. Those companies, those tenants are more cautious in signing new contracts, new leases, which in practice has turned the vacancy up. And this is actually what you see here in this graph. That shows actually what is happening on vacancy in the US market. And as you can see that the highest declines in occupancy, they are shown under the office sector compared to the other subsectors. Now, geographic-wise, yes, US has been affected more compared to the rest of the world, especially Europe. Some data show that US office space utilization is around 50% of pre-pandemic levels. And if you compare that with 70 to around 90% in Europe, then there is a significant impact over there. And actually, occupancy in Europe is improving over the last quarters. And let me also show you this graph, which may be interesting. And these two. So this shows the level of occupancy in main European cities. And here is what is happening during the week, where we can see that the occupancy is very close actually to pre-pandemic levels, especially for midweek. So Tuesdays, Wednesdays, Thursdays. By the way, what is important here to highlight is the fact that this kind of what is called peak loading effect, so practical terms of peak office utilization, is what really drives demand. For example, let's take a very simple scenario that a tenant only occupies its office on Tuesdays, where they get all the employees on that day. It means that they will need the same amount of office space, even if they were occupying the space for the whole week. So the 63% or so here compares to around 70% pre-pandemic. So practically, the European market is faring better lately. However, not all assets and asset classes are equal, in the sense that the high quality assets or the high quality offices, they seem to outperform because tenants are actually focusing on high quality assets as a strategic tool. So you can see a value gap between the best and the rest, if you can put it this way. And we'll explore more on that when we discuss about sustainability a little bit later on that. So that's about offices, but what is happening with logistics assets? Logistics, they have performed quite well. And you can think about logistics as being the other side of the coin in terms of the impact from COVID, because they have really benefited from the structural changes COVID has brought for plenty of reasons. First of all, growing e-commerce, which has helped the demand, investments in reshoring or near-shoring investment activities, investments in actually building capabilities for same-day delivery. All of these things, they have really led to increased occupational demand, which in turn led to higher rents, lower vacancy. Here in this graph, actually, you will see that this kind of impressive improvement in vacancy over the last decade, I would say. Here you can see since 2010. And lately, of course, because the tenants are a little bit more cautious or because there is more speculative construction of logistics space, you see a higher uptick in the vacancy. However, it is still below the long-term trend. So logistics, they have performed quite well. And this is also a quite interesting graph. This actually shows the penetration of online sales. So practically it shows the impact of e-commerce. This is before COVID and during COVID and after COVID. So you can see here that the online sales penetration has really jumped significantly during COVID. This supports the demand that we just talked about. And since then, the penetration has actually reached new norms, a little bit down, of course, as expected, but they are now at a new norm level. However, this actually demonstrates that still consumers value the physical retail. By the way, the UK market or the UK penetration rate is higher compared to other European countries. So we have talked about, or we have actually mentioned now retail and what's happening with logistics and e-commerce. Let's now turn to retail. So what is happening to retail because of COVID? You may remember that during COVID, the retail market was really affected because you remember the lockdowns led to store closures, defaults on rents, high-profile retailers going bust, just like Debenhams. The reality is, though, that yes, retail certainly faced structural issues, but this happened even before COVID struck. Many examples about that. Floor space oversupply, historic overexpansion of retailers because they were looking actually to expand, chasing scale, rental declines, the growing e-commerce that we just mentioned before, or even retailers actually doing brand evaluation by huge discounting. So all of these things actually have impacted the retail sector much before COVID struck. So in practical terms, the sector had more time to reinvent itself and adjust. What does it mean is that there has been much more limited development, tenants upgraded their stores, building last mile and omni-channel capabilities, and practically improving the branding of their companies. And this has actually resulted in the footfall improving, especially lately. And this happens actually, especially for retail parks, where access was much easier even during COVID. And you can see here the purple line. The fact is that the footfall in retail parks more or less the same as it used to be on the pre-pandemic levels. And lastly, let's talk about what is happening with hotels. Hotels, again, you may remember during COVID, the majority of them, they were just closed, especially in the lockdowns. However, the recovery has been quite remarkable. It has mainly led by increased room rates. It started with very strong performance of regional hotels in 2021, mainly due to staycation trends. And this had followed by London hotels due to the pent-up demand over these years. And as you will see here in the chart, the top line revenue has really grown significantly, driven by what is called ADR, average daily rate, so practically the prices. And they have really exceeded the pre-pandemic levels. The bottom line is a little bit more challenging because the costs have increased significantly over the last years, especially labor and energy costs. The energy costs are going down over the last quarters or so. Roman touched upon and actually described in very detail the residential market, so I will skip it here from our talk. And another very important headwind is sustainability, or changes brought by the focus on sustainability. I think Professor Skiadopoulos mentioned that you had a similar discussion on ESG some time ago, so I will try not to elaborate too much here because you already know the key elements of that. I will just try to be as focused as I can on properties in this case, because sustainability has many different facets. It can take the form of regulatory requirements, for example, a requirement for a building to have a minimum energy performance certificate, or a company, a tenant, achieve a net zero target over the years, or even a tenant having reporting requirements, such as what is called the TCFD reporting standards. All of these starting regulations means that sustainable buildings, or how we call them future-proof buildings, will be considered lower risk, which in turn will affect their value. So that's one thing about sustainability. The second thing is that it can be, actually, sustainability can play an extremely big role in the strategy of a firm, in the sense of attracting and retaining both staff and clients. For example, a property can, or an office, for example, can actually help in convincing employees to get back to the office. It can increase their productivity, or a retail space can really improve the branding of a particular company. So all of these are related, for example, with the holistic approach to employees' well-being. Apart from this, there is also the cost, of course, implication from sustainability. Thinking about, for example, energy efficient properties are typically much cheaper to run compared to the traditional properties. And usually those can really attract better financing costs as well. So all of these impacts can really result in a polarization in the market between the prime assets and the secondary assets, both from an investor's perspective, in the sense that reflected actually in valuations, but also from a tenant, from an occupier perspective, which is actually reflected in both rents and occupancy rates of the properties. And talking about that, this graph here will be useful actually to understand why, or to understand what is happening. As you will see on the right-hand pie over here, occupiers are nowadays, they're focused on best quality, best located assets. The graph here says that the grade A offices, which are, the very good quality offices, the leasing for them is around 10% higher compared to the pre-pandemic levels. And that's an important actually element when thinking about where to invest, thinking about where the demand lies. A similar picture is shown here as well. Here, what this graph shows or highlights the fact that there is a slowdown in leasing since COVID, but this is mostly felt in the second-hand properties, so the poor quality properties. Because best-in-class buildings, and actually what is best-in-class? Best-in-class is associated with access to high-quality amenities, large terraces, large floor plates, availability of, let's say, toilets for employees, bicycle racks, etc. All of this typically can justify both a rent and a value premium. So practically, the office space that can align with sustainability targets of a firm, of a tenant, can support the employees' well-being, and it also helps drawing back those employees. So practically, these properties or these offices are more attractive, which practically means rents are higher, and this really accelerates the obsolescence of this secondary space shown here in this graph. So all of these cyclical and structural effects have really naturally impacted investment volumes, especially the cross-border ones, cross-border meaning foreign investments. The investment volume has been down around 50% over the last couple of years. So some people will say that, well, in that case, they may look at this graph here, which shows the total returns. Roman also touched upon them on the residential market before. But some people may say here that just by looking in this kind of negative returns, whether that's the end of the market. My personal opinion is that the answer is no. The sector has proven to be adaptable over the years. companies are really expected to reposition themselves and, of course, consider what's the best use for each of their assets, for example, by repurposing certain assets to align with occupational demand. Total returns you see in this graph on the right-hand side as well have been normalized very recently as well. And always there is interest for prime future-proof assets. This doesn't mean that the price discovery may not continue going forward, but at least the asset pricing has adjusted over the last year or so. It has been led by the US market, and the UK market has actually experienced the largest adjustment in Europe since last year. So the market also experiences nowadays interests, not only in prime assets that I just mentioned, or future-proof assets, or just by repositioning assets, but also in the alternative sectors. An example is data centers, which is practically led by more demand for AI or digitalization. Or another example can be life sciences, again, similar demand dynamics, and senior living, so for older people, which is practically led by the demographics. And all of these combined will form part of the sector reinvention going forward. Of course, last but not least, again related with sustainability, a substantial opportunity is out there at the moment, and it is related with making properties green. So practically by upgrading them and hence future-proofing them to get occupational interest from tenants. So yes, I think I have spoken a lot, and I think it's about time to get to the most interesting part of the discussion, which is your observations and your questions.
Thank you very much, Panos, for another stimulating presentation. So now we're getting into the Q&A session. So may I remind you to send any questions you may have. You may submit them either in the chat box, or you may raise your hand in case you wish to pose a question orally. May I also remind you that the session is video recorded, and the videos are going to be uploaded on the events website. We'll send you more information in due time. So until more questions come up, may I break the ice by asking the first question to both speakers. So real estate in general is a very heterogeneous asset class. So this reminds a bit, of other asset classes like commodities, where people are trying somehow to measure the performance of this asset class by constructing indices. And actually, Roman showed a lot of information on housing prices, and Panos likewise. So my question is, how representative are these indices so that we can assess whether the information we see is genuine or whether the information is somewhat biased? In some cases, actually, vendors may be promoting in a way, performance, even though performance may not be there for certain, say, types of real estate. So that's my question. Thank you.
Excellent and difficult question, Professor. Very difficult to answer that. The fact is that the UK market is very transparent and very big from an investment point of view, or from an investment size point of view. So the available data is very significant. There are so many transactions going on, well, not over the last year or so because of the challenges the market faces, but the data points available, both from a rental point of view, so income point of view, and from price point of view, it's very big. So I believe that my personal view is that, especially for these developed markets where there is transparency, where there is big availability of data, and the markets are globalized, so you have investors from across the world coming in, indices can really be a good representation of what's going on in the market. Of course, each asset class has subcategories, its location is different, so you need to be an expert in the market to make the proper property selection. But if you think about that from a macro perspective, then the data can be representative, I believe.
Thank you, Panos. Roman, any views on that?
Well, I certainly wouldn't be the right person to give tips to, where to buy what property. I mean, it is by the very nature, a heterogeneous market. I mean, each house is different, right? And it's impossible, to have a good theory that would cover all this heterogeneity. We can generally say something useful about the aggregates. When you aggregate up, we can talk about the economy as a whole to the extent that, markets across locations, I mean, they tend to move together, over the long run and the business cycle, but that does not mean that, you cannot have some, local knowledge that, would allow you to make excessive return on the basis of that. The best thing you can do as a person is to buy a house from which you're going to derive, big D personally. The D in that model, the dividend, how you value it. So you care a lot less about, what's going to happen to the future P. If you derive your lifetime living in the place, big enough D, then you can be happy. As a person, as a household, as an investor, I mean, that's a different story.
I was mostly referring to the indices you saw. So what kind of indices are these on which you base your study?
These are so they came from different sources depending on the length of the period. So the standard data that we have is OECD has these indices from 1970 for most countries, and then they add on countries, as they become more and more developed, and so the data that they get, it becomes more and more reliable. So the way where OECD gets this data is from the national statistical agency. So in the same ways, for instance, as a Eurostat or BIS, they are all the same data that are just collected and presented by these agencies that come from the national statistical agencies, which get them from the registries. Okay. So none of the data that I have shown is quality adjusted, or it's not even calculated per square foot. This is literally, the average price of a property as based on, the registry data of the individual countries. The much longer term data that Knoll and co-authors have collected, it's based literally on historical records. So they went to, to various publications by national statistical agencies in the form of books, and they collected, over many years, the data set. So it's publicly available. The data set that comes with that paper that I have used as a source, and that's right now the best available data covering, average, again, talking about average aggregate house prices over, 100 years and more. Nowadays, for the local, for instance, in the US, at the local level, people tend to use a lot of Zillow data. There are other, more kind of granular data that are available for, local markets, but these are more recent data.
And on that point, Roman, actually, there are a number of data providers, even from banks like NatWest Indices, Halifax, or even from Zoopla or other online providers. So there are kind of big statistical data available nowadays.
But this is, again, that covers the more recent, the more recent period. So anytime, you want to draw more historical lessons, the only options that you have, and especially when you want to do cross-country or comparison, is OECD and or BIS or this Knoll and co-authors data.
Okay. Are there any questions from the audience? I see no questions in the chat. Is there anyone from the audience? So Linzin Zhu, feel free to ask your question.
Excuse me, can you hear me?
Yes, yes.
Sorry. Okay, I want to talk about the Chinese property market, especially the residential property. We may begin with the current situation. The price of China's residential property is very high, and the per capita income of China is not that high. I don't think it's high enough to support the price of the current of Chinese market. So how do you think of Chinese property market, especially the residential market? And look into the future, as we can see from the data, the economic growth is slow and the population growth is also going down. So how do you think of the price in the future? And we all know that the property was supported by the debt, the leverage. And how can we pay for that? How do you think of this market? And do you have any suggestion for resolve this problems? Thank you.
So maybe let me start. So there is actually a co-author of mine, Carlos Garriga, who is the head of research at the Federal Reserve Bank of St. Louis. Him and his co-authors, two of which are from China, they have a paper on house prices in China. If you just Google Carlos Garriga or the head of research in Louis Fed, you can locate the paper, which I think is one of the better papers, academic papers on the recent the developments in China over the past 10 or 15 years. And they argued that a lot of the increase in house prices in China it's got to do essentially with urbanization, as in other emerging economies. So that's a key aspect. Then of course, I didn't talk about debt finance or any kind of financing aspect of house prices. You can think, so if you want to think about it in terms of like a very, very simple model that I have outlined, so all of that debt finance, I mean, regardless whether it's the interest rate, the structure of that, what kind of a mortgage, what kind of structure of the mortgage that supports that financing, all those aspects kind of get summed up in that very basic model in that R, in that rate of return. Okay, so for instance, it's often argued, if I use, not talking about China, but as a kind of analogy, the boom period in the United States, the kind of easier access to finance that happened through various financial innovations, you can really think about it. I'm talking very loosely, but it's easy also to show formally. You can really think about it as a decline in that R. And in that very simple model, a decline in R leads to big departure of house prices from their fundamentals. These are kind of more general comments because I'm by no means expert on the Chinese housing market, on the details of that. But these are two general ways how perhaps you could think about it. And as I said, you could, I would suggest, if you're really interested, to take a look at that paper by Carlos Garriga and their co-authors.
Panos, is there something that you would like to briefly add? May I simply state that there are a couple of more questions. So to make, given that we're running out of time, if we could briefly respond to these questions, that would
Absolutely.
be very
Absolutely, yes. Totally agree with Roman on what he says about the market. It's actually an extremely interesting market because it develops as we speak. So it's very dynamic. There have been some events, even this week or last week as well, with the government intervening or not intervening in some special situations. So it remains to be seen what will be the result, because it's not only about fundamentals, it's about policy as well. So we don't really have a full picture of the real impact that this can have if policy is instigated on that. So we will see about the result, but it's a very interesting space to observe over the next months.
Great. Okay, very quickly, there is a question on your expectations about interest rates. Do you expect them to decline in the foreseeable future? If so, when and why?
I think that this topic has been discussed very extensively in the papers, in the markets generally. Nobody knows what the rates will be, because you don't really know how the economy will be impacted by the existing rates, where the inflation will be. With all the geopolitical risks happening at the moment, again, there is a big uncertainty of where this will be. There are signs of stabilization, and that's important. And this actually is reflected, let's say, to mortgage rates. So lately you have seen adjustments to mortgage rates from UK high street lenders, for example. So there are signs, and you can actually see how the swap rates are moving to get an understanding, an idea of where the market thinks about the interest rates going forward. But where they will be, it's a type of, it's a forecast, economic forecast that nobody can really predict with accuracy at the end of the day.
Roman, your view?
I agree. When you look at what they call the market implied interest rates, which is basically interest rates extracted from various fixed rate instruments that give indication where the market thinks interest rate is going to be. It looks like across many markets, across many countries, they seem to be converging to like 4% in based on these implied rates in about 3 years' time. Now that is a little higher than the central bankers would like them to see potentially, because you have, again, looking at historical data, the real interest rates been around 1% on average. And if a nominal interest rate is the real interest rate plus inflation. Okay, so the market seems to think, based on this simple calculation, that basically inflation is not going to go back to the target. Okay, so inflation rate of about 3% in the long run instead of the kind of more standard 2%. So rather than making a forecast here, I think it is a risk that it will be difficult for central banks to get the inflation expectations to those 2% and hence achieve the 2% target. In the longer they will keep, interest rates at high, the more likely they might be able to convince people that they themselves do not believe that inflation is going to decline in the long run anytime to the 2%. So I think it is a risk that we're going to converge to something higher than we are used to, or we have been used to historically.
Okay, thank you. There is a question on ESG, green issues, whether they will have an impact on land availability and the types of commercial or residential properties being built or planned to be built. I believe Panos has answered this.
It's a very interesting topic, actually. And you may have seen a very recent example on that, on Marks and Spencer, a building on Oxford Street. So Nigel may look into that online as well. What you need to think about when you're actually trying to incorporate green approaches in your investment needs is the fact that how does this really impact your decisions about, let's say, refurbishing or demolishing and rebuilding a property. These are very, very interesting and very crucial, I would say, topics to be discussed. And my personal belief is that going forward, they will be even more important. So definitely a space that will develop much, much further in the next years.
Great. Yeah. So I thank you, Panos. So I believe we have reached the end of today's event. The two speakers have been super punctual, so thank you very much for respecting the time. And thank you also for contributing to this very exciting and timely topic. So thank you, Roman. Thank you, Panos.
It's been a pleasure.
Of course, may we thank the audience as well for spending 1.5 hours of their lives with us. We hope that you found today's event interesting. Please do stay in touch with the School of Economics and Finance community. As Jason mentioned, CEF is developing fast, is a well-recognized department in UK and worldwide, as is Queen Mary University of London. Please do stay in touch. We're going to let you know once the website for today's event has been constructed, so that you can watch the videos again if you wish. And we wish you a nice day, morning, afternoon, wherever you reside, or evening. And we're looking forward to seeing you all again soon in one of our future events. Bye-bye.
Thank you. Bye-bye.
Bye, everyone.